I'm here at the Black Diamond Conference for Money Map Press. I'm joined by Shah Gilani, who's a capital wave strategist and also the editor of Wall Street Insights and Indictments. Shah, great to have you here today.
Thanks, great to be with you.
Well, the month of January has finally kicked off and 2018 is well underway. Now, we've seen plenty of upside for the equity markets and triple-digit moves for the Dow Industrials. Overall, it's been a good year so far for the equity markets. So what do you expect to see in terms of trends?
I think we're going to see more of the same because the trend is your friend and the trend has been up since 2009. And we've seen excessive buying and momentum buying into the end of the fourth quarter and certainly in the beginning of this year. So I don't think there's any really major headwinds facing the markets that's going to cause anything to reverse.
And when we look at the broader fundamentals, Fed Reserve rate hikes are expected and focus will be on politics out of D.C. But you're known for calling rebounds as well as crashes, so I do want to get your take on what we can expect to see.
Well, again, I think momentum is your friend, and that's what we've got. We've got a lot of momentum behind the market. Earnings have been great. They were great in the fourth quarter. I think they're going to be outstanding when they come out. I think the third quarter was double-digit, 11 to 12% earnings growth. We'll see more of that in the fourth, and I think the first quarter will carry that forward too. So behind that, we've got the tax cuts. I think that's going to help, in terms of buybacks. Repatriated money is going to go back into buybacks. It's going to elevate stocks. We've got a lot of momentum behind the market, and there's really nothing facing the markets that's going to reverse that. Nothing. There are always mechanical issues with the markets that folks don't understand. So there's always a chance, a possibility of a sell-off, but that's a mechanical issue. It's not fundamentals. The fundamentals are sound.
Well, I do want to ask you about volatility as well. And for people in our viewing audience who don't know about your background in developing the VIX, can you tell us a little bit about that and where you expect to see volatility?
Certainly. Well, the early 80s, when I was on the floor at the CBOE, we were trying to price the options correctly. We were using the Black-Scholes model because that's what everybody uses. But what we found out was they didn't compare. There was nothing in reality that measured volatility the way we thought it should be measured. When you break apart the Black-Scholes model, volatility is a historical measure within that equation, if you will. It didn't work for us because the market didn't price options that way. So we've had to figure out why it was pricing the options differently, and it was pretty simple. It really came down to the market was pricing options based on what the expected volatility was that traders thought they were going to see in the next 30 days. So we started to extrapolate those numbers out, and we came up with what the implied volatility was. We actually measured that when the OEX started trading, which was the S&P 100 in the early 1983. We then incorporated that, what we had created for regular options for the OEX, and that became the VIX, which is the measure of the volatility of the market. Now it's the S&P 500, not the 100, but that's really the genesis of what the VIX was. We started that. It was necessity being the mother of invention. And VIX continues today to be something that a lot of investors watch. I think it's been pretty much quiet for a long time. I think 2018, we're going to see a pickup in the VIX. I think we're going to see more volatility throughout the year.
And Shah, another thing that investors out there are watching are earnings. Now, I understand that you have a particular take when it comes to earnings reports. So what should investors be watching for?
Well, I think the typical earnings season, a lot of the companies talk down their earnings because they want to be able to beat the consensus estimates for their earnings, and I think that's very typical of Wall Street. So I think that's going to continue. But I think what's going to happen on top of the earnings being talked down is they're going to beat exponentially harder and higher than what their consensus forecasts are. So that's going to continue to provide food for the market, and I think, again, that's just part of the momentum. There's a lot of different pieces to the momentum equation, and earnings are certainly going to be a big one.
And last but not least, I want to ask about disruptors. I understand you wrote about disruptors recently for your newsletter, and you're watching AR as well as VR. But what about cannabis and cryptocurrencies as well?
Well, cannabis is something I think it's still too early to get involved in. There's not enough information on the stocks that are out there, and the companies are small, and it's not really my cup of tea right now. I think there's going to be a tremendous opportunity in cannabis stocks. It just matters after the consolidation occurs, there are going to be some players that are going to be worth buying. It remains to be seen who they're going to be. As far as cryptos, frankly, I think that blockchain, everybody knows blockchain is the future. As far as cryptos, in terms of Bitcoin, I don't think that has a future. I think that with an asset class that doesn't have any intrinsic value is subject to the kind of volatility we've seen already in Bitcoin. I think any of the ICOs that aren't backed by something positive, something tangible, are going to have the same kind of future as Bitcoin does, which is volatile.
Okay, well, thank you so much for joining me, and thanks for your insight.
Thank you.